First, let's get to our market panel. Victoria Greene of G Squared Private Wealth and Jeffrey Kleintop of Charles Schwab. Guys, welcome. Happy Thursday. Victoria, 56.48 is about where we started the month with the S&P, and we're 100 points higher than that. So unless we drop 2% in 2 trading days, this is an unusual September, no?
Why would you bring that up? Why would you even put that on the table, John? Come on, we're looking to break a 5-year trend of negative Septembers here. I do think we'll be able to rally out. PCE is supposed to be benign tomorrow, 0.1 to 0.2, depending on the rounding for core. It's likely pretty in line because of what we saw in PPI and CPI. So as long as PCE cooperates, I do think we can have September better, but why would you even tempt fate with that?
I know, playing with fate here. And Jeff, we're talking a lot about China today, but overall, international markets have been performing pretty well lately, where the U.S. had been outperforming. So how sticky might that be outside of China even?
I like what I'm seeing. You know, we've seen leadership by rate cut beneficiaries like financials. Financials have double the weight in the EFI index versus the S&P 500. They're doing very well, best performing sector in the third quarter outside the U.S., helping to sustain those gains. Obviously, I mean, China's in that picture as well, right? Because there are a lot of European luxury product makers, like many of those that rose sharply today, that would do better on a Chinese consumer. The jury's still out whether this stimulus translate into actual growth, but that's another plus here that we can look to for the fourth quarter. China continues to apply more and more stimulus.
Victoria, how, if at all, do you play this China stimulus trade?
I mean, it's great for some of the discretionary and luxury, as he was talking about. And I think I'm a little more wary on how lasting this impact is, because they still have a huge issue in the real estate sector. But this is what the market was waiting for 3 or 4 months. So you saw casino stocks rise. That might be a great play. They're very sensitive to the whales from Asia coming over. And then what's happening in Macau, we saw them have a good day. We could see Chinese tech stocks continue to run, like Alibaba and some of those names. They've got a long way to go to catch up with the rest of the world. So you could see a run there because China has implicated themselves, and hey, we are going to step in and support this. I prefer U.S. stocks, a little more quality, a little less exposed to potential tariffs, trades, and all that nastiness that may come down the pipeline in November. I stick with my U.S. bias, but it's nice to see it broaden out. It's nice to see some of these sectors in travel and leisure get a China bump, because that has been a huge headwind to most multinational corporations. I think you could, Apple may be a big beneficiary, Tesla with Chinese sales. If we could see Chinese sales pick up for a lot of these multinationals, it's great for not only international names, but also U.S. names that have multinational exposure.
Jeffrey, speaking of tariffs, there have been a lot of elections so far this year, a couple big ones coming up. There's been a nationalist shift in how those have turned out, not yet having an impact on the markets, but might it if we see barriers to trade rising up? And is that something investors should consider?
It is probably the biggest risk coming out of this election that affects investors directly. But we've got to keep in mind, even with those Trump 1.0 tariffs back in 2018 and 19, we really didn't see overall tariff levels for the U.S. go up. They're still at 2% on average. That's the average U.S. tariff. And that's because they were applied to things, a very small amount of U.S. imports. That could be the case again. Heck, I'm hearing about 60% tariffs on imports, 100%. We've got 6 weeks to go. I wouldn't be surprised to hear about 1,000,000% tariff on some type of imports. But the actual reality is, as we've seen from elections around the world, actual policy implementation, very different from proposals. I think those would get watered down quite a bit.
So, Victoria, you say you still prefer U.S. stocks. What, therefore, are the major trends, despite all this uncertainty, maybe around how much legs the consumers got, et cetera? What are the major things that you think investors can continue to go back to and maybe average into, even as we see the S&P at these record highs?
Sure. I love rate-sensitive names. We've been hammering on REITs as a great place to be. We love utilities, the electrification and powerification play in utilities and industrials. We think both of those areas are areas of picking up quality names. A lot of them have dividends and cash flow. I'm a sucker for a good free cash flow. It's one of the hardest things to manipulate. If a company is generating free cash flow and dividends, I love it. As we talked about earlier, financials are a big beneficiary. That sector's been doing well, and we are keeping our core technology. As we talked, I think Closing Bell talked about, hey, maybe average into some of these semi-names. That's one of the areas that hasn't hit records yet, still about 10% below their highs. And if we see EPS grow as we think it will, it's supposed to be led by health, by technology, and those are areas I want exposure to. Who has growing EPS? Who has strong free cash flow? Who has good balance sheets? Who's paying dividends? I love those stocks because, to me, those can be both bunkers and builders if this economy continues to run. I'm a little less concerned about valuations because in a bull market, obviously, we tend to see the PE multiples expand, and I think you could continue to see PE multiples expand if we get some of the earnings growth and this upward bull market to the 6,000 target I have on your end.
All right.